We've had a number of guests on the show in recent days really singing the praises of staples. Why are you bullish right now on staples in an environment where we're seeing higher for longer rates that seems to be weighing on the rest of the market?
Well, I mean, part of it has to do with that issue of the entire market. As the biggest thing on a broad case is that we have a situation where the stock market, the bond market has been pricing in this thought of higher for longer for 6 months now, and the stock market has not, or it's just starting to in recent days. So recent weeks, I should say. So we have a big divergence between what's going on with the bond market and the stock market, and whenever that happens, and to the degree that it has this year, the stock, that's usually resolved with the stock market coming down more. So I think people need to get a little bit more defensive. But a lot of it also has to do with the technicals. We see the XLP Consumer Staples ETF becoming very, very oversold. In fact, it's the most oversold in a half a dozen years. And the same thing with some of these individual stocks, which are finally becoming a little cheap. I'm afraid, I do admit that the entire group is not exactly cheap, but there are some individual stocks that I do like here that are becoming cheaper here. So it's a group that I think is going to do better for the rest of this year after a very, very poor 6 months.
All right, Scott, I want to come over to you. You got the bear case. One thing I want to address with you right now is that right now we're hearing more and more people say you have to judge companies by the qualities they have when it comes to margin, profitability. I'm looking at the staples. According to FactSet, 59% of staples in the S&P, they saw profit margin expansion last quarter, second only to communication services. If we're seeing margin expansion, why are you so bearish on the staples right now?
Well, because, Frank, you have to figure out, why are margins expanding? And in the case of staples, they love inflation. So if you have a commodity-driven good, if you have kind of consumer staple-driven good, and you have a lot of inflation, you can pass that along to consumers, and with higher wages and with all the stimulus that got put in people's pockets, they can pay it. So the staples companies weren't really hurt on the input side of the equation in terms of inflation, but they were really helped out quite a lot by the output side, by the prices they could charge. So they could raise prices quite a lot, and that really helped their margins, which obviously led to a really nice year in 2022. But this year, and we think going forward, as we see inflation collapse and come down pretty sustainably, that margin tailwind that you had when inflation was high is just no longer there.
All right. Matt, I want to come back over to you. Again, I know you are very bullish when it comes to consumer staples. How big of a factor are dividends when it comes to this story? I'm looking at Kimberly-Clark, for example, a 4% dividend. Do we see other, generous dividends when it comes to other consumer staple stocks?
Yeah, you mentioned Kimberly-Clark. I mean, one of its big competitors is Procter & Gamble, but its dividend yield isn't quite as high. So that's why I like Kimberly-Clark. But I also like Archer Daniels Midland, General Mills. These are two stocks that are relatively cheap, or actually quite cheap. A lot of these names aren't, even though they're a lot cheaper than they were 6 months ago, they're still not necessarily cheap. But you look at Archer Daniels Midland, which sometimes people confuse the ticker with Advanced Micro Devices, a very different stock, obviously. But they pay a nice dividend of over 3%, almost 4%. Same with General Mills. And, with the short-term rates at high levels, this may be not as important to some people as it has been in the past, but I still think it's important. It pays you to wait in a group that's fine, especially in these stocks that finally become cheap. And so I think they're a good play here and can be very important in that respect.
All right, Scott, back over to you with the bear case. So you mentioned that these stocks actually benefit from higher inflation. So it sounds like you're in the soft landing camp right now, and you're saying if we're going to have a soft landing, it's time to jump off these stocks?
Yeah, look, for staples to work, you need some sort of catalyst. You need basically a bad economy catalyst, or you need a high inflation catalyst, or ideally both, if you really love staples. But we just don't see either of those catalysts really coming through in the market right now. We think that the market's seen this. That's why we've had such poor performance as a group for some of these stocks for the year to date. But if you're not going to get the bad economy catalyst, you're going to get a soft landing. If you're seeing inflation decline pretty appreciably and pretty steadily, just the tailwinds that we had for these things are just gone. So you have to look outside of the sort of the stocks that gained from the inflation trade. Maybe you look to a Walmart that is didn't really pass on as much, didn't need as much inflation to generate margins, didn't need as much inflation to generate revenue gains. Something like that might work in an environment like this. But really stay away from anything that needed inflation to maintain margins.